If you're thinking of choosing a variable rate mortgage in Canada this year, towards the end of 2025 or 2026, you might actually want to hit pause first, because what looked like a smart move back in 2020, 2021 actually turned into a nightmare for a lot of Canadians. Now that rates are coming back down, people are asking, is it safe to go variable? In this video, I'm actually going to break down the 5 big reasons why you may want to stay away from variable rates in 2026, unless you have a really good understanding of what you're signing up for. I'm a mortgage agent, but I'm also a realtor in Oakville and around the GTA. I help people with their financing on mortgages, refinance, get out of debt, and I also help investors invest in real estate. And on this channel, I skip the fluff and give you the real world mortgage advice that actually helps you make better financial decisions. Go ahead and click the like and the subscribe button, because it will help a lot of people find these videos and help people make decisions that can benefit their financial future. Reason number 1 why you may not want to go variable is the biggest mistake people are doing is just assuming that variable saves them money. For a variable rate mortgage to beat a fixed rate, interest rates have to fall enough and stay low enough to make up for the time you spent paying more at first, if that makes sense. Let's look at where we are right now. And I'm filming this towards the end of October 2025. The average 5-year fixed right now is in and around the 4%. There are some 5-year fixed rates that are below 4%. Variable is around the 4%. So if you're betting on variable to save money and rates only drop, let's say, another 0.25% for the rest of 2025, and then maybe just another 0.25 in 2026, you might barely break even. And that's assuming you stay in the mortgage long enough for it to benefit. And if your variable rate is getting higher than the fixed rates, the odds of coming out ahead get even worse. Because let's be honest, we really don't know what 2026 is going to hold and what the Bank of Canada is going to do. It's not just about what rates do next month. It's about how far and how long they move. And if you're making a mortgage decision based purely on a hunch that rates have to go down, that's a gamble, not a strategy. Okay, so reason number 2 why variable might not be good in 2026 is payment shock. And let's talk about it, because this is where most people regret going variable, especially over the last few years. When you choose a variable rate, your payment can change when the Bank of Canada makes their announcements. And if you have an adjustable payment mortgage, which means your payment goes up and down right away, it will affect you when the Bank of Canada makes their announcements. But if you have a fixed payment variable, which means your payment stays the same until one day it doesn't. Once your payments stop covering the interest, the lender increases or stretches your amortization. So when the Bank of Canada raised all of their rates, people had payment shock, and that's when homeowners start packing. So according to the Bank of Canada, roughly 60% of mortgages renewing in 2025 and 2026 will see higher payments. So if a $300 or $500 increase per month would throw your budget, variable is not for you. If you want predictable payments and the ability to sleep at night, a fixed rate is probably a safer move for you. And reason number 3 as to why some people should just go variable is what I like to call relationship risk. If you're buying a home with a partner, both people need to be comfortable with the risk of a variable rate. If one of you is fine with the ups and downs, but the other can't handle the stress every time the Bank of Canada announcement is coming, then you're setting yourselves up for tension in that relationship. I like to call it the 2 yes, 1 no rule. If both say yes to variable, then that's fine, do it, go for it. But if one says no, go fixed, or just choose a short-term fixed rate instead, your relationship is worth more than that 0.5% of potential savings. Reason number 4 is short-term fixed is often smarter. And let's say you're planning to stay in a home for 5 years, okay? Maybe you sell, maybe you refinance, maybe you upgrade in a year or 2. In that case, instead of gambling on a variable, look at a short-term fixed rate, maybe 1 or 2 years. Yes, the interest rate might be slightly higher, but this strategy locks in predictable payments. It gives you breathing room while rates settle, and it keeps your options open. But that's only if you know you're going to be making changes in the next year or 2. It's the middle ground between safety and flexibility. So you can reevaluate later without worrying about any major payment swings or giant penalties. And if you want to stay flexible, short term often beats variable, especially when the starting gap between the two isn't that big. And reason number 5 is not all variables are created equal. If you're leaning towards variable, here's the kicker. Not all variable mortgages work the same way. There are 2 main types, adjustable payments and fixed payments. With adjustable payments, your payment changes when your rate changes. So when the Bank of Canada makes an announcement. So your amortization stays steady and you're always knowing exactly where you stand. With a fixed payment variable, your payment stays the same for now, but if rates rise, you most likely only pay interest and barely touch any of your principal, and eventually you'll hit your trigger rate, which means, and that's when your payment jumps or your amortization stretches like crazy. And if you decide to lock into a fixed rate partway through your variable term, some lenders force you into a much higher posted rate than when you convert. That's an expensive surprise you don't want. So unless you fully understand what type of variable you're getting into and what your lock-in rules are, don't take it. And here's my little bonus one here. Now, I'm not saying that variable is always bad. It can still make sense if a few key things line up. Number 1, the rate gap between variable and fixed is small, or even reverse, meaning variable starts cheaper. Number 2, you've got a financial cushion, which means you can handle a few rate increases without throwing your life out. Number 3, you're comfortable tracking the market and adjusting your budget if and when the Bank of Canada does decide to raise rates. And number 4 is you got a broker who explains everything to you, penalties, conversion rules, and payment change before you sign. It means call me, I'm a good broker. And if all that's true, sure, a variable mortgage might work for you. But for most Canadians in 2026, fixed or short fixed is the more logical way to go. I will end with saying this. Variable rate mortgages aren't evil. They're just misunderstood. They work beautifully for the right person or right people, and most of the time, they're a bad fit for a homeowner who just wants stability and peace of mind. So know who you are, know what your risk tolerance is, and before you pick a mortgage, ask yourself these 3 questions. How much risk can I actually handle? How long am I staying in this property? And do I understand exactly how my payments and penalties work? And if you can't answer any of those 3 questions confidently, go with fixed, or go short-term fixed and reassess in a year or 2. If you want help trying to figure out which one is best for you, fixed or variable, click the link in the description and I'll show you exactly what works for you and your budget and your long-term goals. And if you found this helpful, please don't forget to like and hit the subscribe button and also drop a comment. I want to know your thoughts. If you made it this far to the video, please tell me what you think, fixed or variable.